Chapter 4. Fair Value. The secret to investing is to figure out the value of something and then pay a lot less. Joel Greenblatt. The definition of fair value in layman's terms is the price at which willing and informed buyer and seller agreed to exchange the asset. It is essential to note the keywords in the definition: willing and informed. For all practical purposes, when an active market is available, the transaction price is considered fair value. For example, in listed stocks, the current trading price is deemed fair value of the subject stock. However, most of the time, critical requirements of fair value, information, and free will are questioned. Not all buyers and sellers have all the available information at the time of transaction. We will discuss this in detail in the section on efficient market theory. In routine market situations, most of the transactions are with the free will of buyers and sellers. However, in the case of market melt-up or meltdown, many trades are forced on buyers and sellers. For example, in a market meltdown, brokers can force sell the shares if the investment was made with a margin account and investors failed to honor the margin call. The most prominent example of this phenomenon was the 1929 market crash, when most stock investments were on insane margins. A minor panic in the market resulted in a total market meltdown and triggered the Great Depression. Conversely, in market melt-up or even in individual stock price appreciation, short positions are forced to close by brokers. For example, if you are holding a short position in ABC company, and for any reason stocks go up sharply, you will be asked to buy the ABC company to close your short position. When this happens, the price goes up, even higher, with all of the buying pressure. This phenomenon is called a short squeeze. It usually occurs only in less liquid stocks. However, sometimes the whole market can be in a short squeeze. It happened in late 1999 and early 2000 during the last leg of the dot-com bubble. In 1998 and early 1999, the stock valuations were already on insane levels, and a lot of market participants expected a considerable correction. In anticipation of this, they shorted the market. However, because of the bubble-type environment, the market kept going up, and these short positions were forced to close by more buying. The market went up vertically before an inevitable crash in late 2000. Last trade price as a proxy of fair value. The funny thing about using the last transaction price as a proxy for the fair value is that even the two people, buyer and seller, who caused the transaction do not agree that the transaction price is the fair value of that stock. They have opposite views about the real value. From the buyer's perspective, the stock is undervalued and will be higher in the future. Perhaps it will beat the market. From the seller's perspective, the stock is overvalued and will go down in the future or underperform in the market. Always remember, the minority dictates the price. A company may have billions of shareholders, but it only takes one shareholder to change the price. The buyer doesn't need to be an existing shareholder. For all other shareholders, this becomes the market price. Imagine you are trying to buy 100 shares of a large company that has 10 billion issued shares. The last transaction price was $100, and now the asking price is $100.01. You desperately wanted those shares before the market closed for the year. You bought those shares for $100.01. Your purchase happened to be the last transaction of the year, and the closing price was $101. You spent only $1 extra and paid $10,001 instead of exactly $10,000. The negligible difference for you. However, everybody around the world now takes this new price and multiplies their holdings by this price. Total market capitalization increased by $100 million. Your decision to spend $1 extra has caused $100 million extra in the company's so-called fair value. You created this new $100 million out of thin air. Each 1 cent increase is making an additional $100 million. Can we confidently conclude that yes, it is real money? Of course not. It is fake money and will disappear with a cent down in the next transaction. Real money is created when this company sells its product to a customer and receives an amount larger than all costs associated with that product, an operating profit. You should never rely on current market prices for fair value estimation, even in highly active markets. The last transaction price is the least accurate method to value an asset. It is suggested that a 50-day simple moving average is a better representation of fair value. In 50 days of trading, a lot of market noise is canceled out. Prices tend to come back to the 50-day moving average frequently. If you are an aggressive investor, you can use a 20-day moving average, or if you are cautious, you can use a 100 or 200-day moving average as a proxy for fair value. PE as a proxy for fair value. Another method that is commonly used to estimate value is the price-to-earnings multiple, or PE ratio. If you take the price and divide it by annual earnings, you will get a PE ratio. For example, the price of a stock is 200, and the yearly earning is 10. You need to take 200 divided by 10, which is 20, that is the PE ratio of this stock. If you divide 100 by PE ratio, it will give you the yield of this stock. In this case, it is 5%. The lower the PE ratio, the higher the yield. PE ratio can be calculated by using the last 12 months of earnings. It is called trailing PE. If you use estimated earnings of the next 12 months to calculate the PE ratio, it will be called forward PE. Sometimes using PE as your guide to fair value can be extremely misleading. An unusual profit or loss item that is not expected to be repeated in the future may skew the PE in one direction. For example, the company sold one of its large businesses and realized a considerable profit. However, this profit will not be repeated in the future, and income from that business is lost. If you use only PE as your guide, you will value this company way above its true fair value. Investors usually use non-GAAP earnings to overcome this problem of skewed PE. Non-GAAP earnings exclude all extraordinary gains or losses from the earnings. Using non-GAAP earnings reduces the possibility of skewed PE, but does not eliminate it. Another challenge of using PE as a fair value guide is that prices generally follow earnings direction, without paying much attention to the quality of earnings. PE of an industry remains typically in a tight range despite a significant increase or decrease in earnings, or quality of earnings. For example, in 2007, the bank's PE remained in the historical range despite increased market prices because earnings were elevated and prices followed. However, the quality of those extra earnings was questionable, but the market ignored it until it was too late. The rest is history. It is easier to use PE as a guide to fair value for established companies. However, when a corporation is in a growth phase and making little profit or losses, PE multiple becomes almost irrelevant. Amazon's price went up from $5 to over $3,000 in 20 years, and for most of that period, Amazon was either making losses or very little profit. Its PE multiple was extremely high by any standard. Amazon shareholders were well rewarded by tolerating high PE multiples and believing in the corporation's potential. However, most of the time, a high PE multiple results in bad endings. Amazon is one success story among thousands of failures. In the case of cyclical stocks like semiconductors, where earnings tend to fluctuate in a vast range, market prices generally follow earnings. PE remains in a tight range, and investors who solely rely on PE miss the opportunity to buy at lower prices or sell when it is the best time to sell. Shiller PE, or CAPE ratio. In a 1988 paper, Robert Shiller suggested a PE ratio variation to smooth out cyclical ups and downs in a company's earnings. Shiller suggested using a long-term earnings average instead of the last 12-month earnings. This variant of PE ratio is called Shiller PE, or cyclically adjusted price to earnings, CAPE ratio. CAPE ratio, or the Shiller PE, is my favorite ratio by far to gauge the market's greed or fear. Shiller PE is an excellent indicator to estimate market overvaluation or undervaluation. However, all valuations are relative, and any indicator should not be viewed in isolation, but in conjunction with other data and estimates. Other common valuation methods based on price are the price-to-sales ratio, the price-to-cash flow, and the price-to-book value. Most of the time, you don't need to calculate all these ratios on your own, as these are commonly available on the internet. Discounted cash flows, DCF. All assets can be valued by discounting their future expected cash flows. The advantage of this method is that it does not require a market price. For beginners, DCF means the sum of all future expected cash receipts, discounted with the fraction calculated using the expected or required rate of return. It is important to note that it is not a sum of all future cash receipts, but the value of those receipts. Cash receipts of the near future have more value than a distant future receipt. It means cash receipts in the first year are more valuable than cash receipts in the 10th year. Another factor that influences the valuation of cash receipts is the expected rate of return. The higher the anticipated rate of return, the lower the values of the future receipts. It means $1,000 in 1 year is more valuable if the expected return rate is 6%, than $1,000 is at the same time in the future when the expected rate of return is 10%. The discounted values of various rates can be easily calculated by using discounting tables, which are commonly available on the internet. In our example above, a discounting factor of 6% in 1 year is 0.943. It means $1,000 in 1 year with a 6% rate of return should be valued at $943. On the other hand, if the expected rate of return is 10%, the discounting factor will be 0.909, and the value of $1,000, in this case, should be $909. Let's try to understand this concept in another way. To receive $1,000 in 1 year, you need to invest $943 now, if the rate of return is 6%, and only $909 if the rate of return is 10%. Discounted cash flow is the most desirable and most widely used method of asset valuation. You should be using this method, even if an active market price is available. Bonds and all other debt instruments are always valued the same way by market participants. As all future cash receipts of a bond are already known, willing buyers can discount the cash inflows with the desired rate of return. They can adjust the desired rate of return with the amount of credit risk they are taking. The higher the risk, the higher the rate. Valuation of stocks through DCF. A stock can and should be valued in the same manner. You should calculate the expected earnings for the foreseeable future and discount it back to estimate its fair value. In the case of a bond, expected cash flows are known. However, calculating expected cash receipts is not easy for common shares. You need to fully understand the business, its strengths and weaknesses, competitive environment, impacts of human behavior, and technology changes, and so many other variables. Valuations based on discounted cash flows for large companies are available on the internet for free or through your broker's website. Professional analysts follow every move of the company and industry and come up with a fair value. You can use these valuations as a guide, but it is always better to recalculate yourself. Always remember that it is not a calculated risk if you haven't calculated it. If you are using somebody else's valuation, then you cannot have the same faith in the valuation as calculated by yourself. When things go south, you will act as a weak hand and will sell your position. You will be doing precisely the opposite of what you should be doing. If you calculate expected future earnings on your own, you will know all of the income streams and all of the good and bad of that business. Until something has fundamentally changed, lower prices will look like an opportunity to buy more, or at least you can brush off market noises with confidence. Adjustment of risk in DCF. It is reasonable to say that investors expect a higher rate of return if they invest in a riskier asset. One way to achieve this is to lower the expectation of future cash flows by a factor of probability. If there is only an 80% chance of receiving $1,000 in the future, then take only $800 as expected cash flows. If it is only a 50% chance, then take $500 only. The other way to incorporate risk in DCF is to increase the expected rate of return. The higher the rate of return, the lower the fair value. For example, if you are buying an apartment, hoping that the local government will build a train station in the near future, it may or may not happen, but you are ready to take the risk. However, you don't want to pay as much as you would for an apartment near an existing train station. You can calculate the expected cash flows, but discount it with a higher rate of return, resulting in a smaller fair value number. Capital Asset Pricing Model, CAPM. CAPM partially solves the incorporation of risk in the expected rate of return and suggests a higher expected rate for riskier assets. However, the CAPM model considers the historical change in the price of an individual investment in relation to the overall market as the single source of risk. This deviation of the price of an asset is called beta. There are critical issues in using CAPM in the real world. First, historical price validity is not the only source of risk. It represents only the price risk. Credit risk, interest rate risk, inflation risk, and all other risks associated with an asset are not considered. Secondly, beta is directionless. It means positive or negative variations in price in relation to the market are considered the same to calculate beta. Another problem with CAPM is that this model requires a risk-free rate. A 10-year treasury rate is often used as a risk-free rate. However, this is only a credit risk-free rate. Treasury bonds are not free of inflation risk or interest rate risk. It is confusing that, on the one hand, CAPM assumes that credit risk is the only risk when considering a risk-free rate, and on the other hand, taking price risk as the only source of risk for individual assets. However, with all these issues, CAPM is still the best model to incorporate risks in calculating fair value objectively. That's why the professional investors community widely uses CAPM. How a retail investor should calculate the fair value using DCF. Instead of using CAPM and calculating a different rate of return for each asset, for retail investors, the better approach would be to reduce the expected cash flows with the probability factor and then discount it with the required rate of return. However, the probability is subjective and depends upon a lot of assumptions. Calculating an accurate probability can be challenging, but at least it would be directionally correct. Intrinsic value. Intrinsic value can be defined simply. It is the discounted value of the cash that can be taken out of a business during its remaining life. Warren Buffett. Intrinsic value is a borrowed concept from ancient philosophy. It means the true value of something. For asset valuation, intrinsic value is commonly referred to as its fair value. Any amount more than its fair value can be called extrinsic value, opposite of intrinsic value. For example, if you calculate an asset's fair value as $100 and stock is traded on $110, this extra $10 is called extrinsic value. The discounted cash flow model of valuation is the most helpful tool for separating intrinsic and extrinsic values. You take all the expected future cash flows and discount them with your expected rate of return. Whatever number you get is the intrinsic value of that asset. Anything above should be called extrinsic value. Some assets don't generate any cash flow whatsoever. For example, gold. Gold does not generate any earnings other than when you sell it to somebody else. If you have a kilogram of gold, it will always be a kilogram of gold no matter how long you keep it. The entire value of gold is extrinsic. On the other hand, a piece of agricultural land can generate real cash inflows by cultivating or renting. It is possible to calculate the expected future cash flows of farming products or rental income. You can discount the future cash flows to calculate an intrinsic value. If the property is being sold above this value, the difference will be called extrinsic value. As a prudent investor, you should try to buy assets below their intrinsic value, but you need to calculate the intrinsic value as the first step of your research. Value trap. Sometimes an asset looks exceptionally cheap on the surface, and you may be inclined to do bottom fishing. For example, a stock with super low PE may look like a bargain, and you will think that the people are selling dollars for a dime. However, more often than not, the stock goes down considerably, even from your purchase price. To add insult to injury, the PE ratio goes up because of eroding earnings. I recently bought call options for one of those value traps. PE was only 5 compared to other companies in the same industry, where the average PE was 35. I was cautious about the value trap, so I bought only call options of over a year's maturity. The stock price dropped to half of my purchase price, and PE climbed to almost 10 as the subsequent few quarters' earnings were well below previous years. My options were expired, worthless. If I had invested directly in stock, my losses could have been 10 times larger. I am not advocating using options, but cautioning you about the possible value traps. What do you call a stock that's down 90%? A stock that was down 80% and then got cut in half. David Enhorn. Efficient Market Hypothesis, EMH. In an efficient market at any point in time, the actual price of a security will be a good estimate of its intrinsic value. Eugene Fama. The efficient market hypothesis has been a topic of interest in academia for over 100 years. However, it gained widespread cultural fame after a 1965 dissertation paper named Random Walk Hypothesis by Eugene Fama. According to the efficient market hypothesis, market prices reflect all of the available information. Only new information can move prices. When further information becomes available, prices change and keep changing until prices fully reflect new information. We can assume that current market prices are true fair value fully adjusted with all available information and risk tolerance of all market participants at any given point. A direct conclusion of this hypothesis is that you cannot achieve better results than the market until you assume more risk. In other words, it is impossible to beat the market. However, a lot of prominent investors and academic scholars disagree with this hypothesis. Advocates of behavioral finance argue that market participants are humans, and their behavior towards new information is not always rational. Human behavior is contaminated with many biases like overreactions, fear and greed, overconfidence, crowd mentality, and the list goes on. Secondly, there is a considerable information bias that exists among different levels of market participants. The majority of the information is not available to everybody, nor does everybody decide after considering all relevant information. If I subscribe to the efficient market theory, I would still be delivering papers. Warren Buffett. I am not well qualified to criticize the theory of rational expectations and the efficient market hypothesis, because as a market participant, I considered them so unrealistic that I never bothered to study them. George Soros. Cumulative perception of risk. In my opinion, both views are correct. Prices are adjusted up to the cumulative perception of risk of all market participants. However, the perceived risk and actual risk are two different things. As people are not rational and are emotionally challenged, and because of information bias, cumulative perception of risk can be different from the inherent risk. Once new information is available, prices will start changing and will keep changing until all market participants achieve their acceptable level of risk, given the expected rate of returns. Markets are not efficient enough. That's why we have market peaks and bottoms now and then. Let me explain with a simple example. Suppose two investors buy the same stock at different price points. The first one buys at $40, and the second investor buys at $50. Suppose the maximum potential of that stock is $100. The first investor is risking $40 for a reward of $60, and the second is risking $50 for a possible gain of $50. The second investor is assuming more risk for a smaller gain because the perception of risk is different. How about the last person who bought the stock at $100? This person accepted a huge $100 per share risk for an actual reward of $0. Obviously, his perceived risk is far smaller than the actual risk. Over the long term, and I mean a very long term, markets are efficient. prices do adjust to risk associated with returns. However, in the short term, market prices are not rationally modified to all available information. Human behavior and information bias play a huge role in transaction prices. It creates short-term opportunities that can be exploited. Human behavior works as a filter between information and prices. In the words of Benjamin Graham, people participate in price action like voters. Some agree with prices and vote yes and engage in a transaction. And some do not agree with quoted prices and vote no and do not participate in buying or selling. Their votes are based on the processing of new information through their inner filters. In the long term, future events either confirm and reinforce their vote or contradict and weaken it. Over the period, everybody finds out whether their decision of buying, selling, or doing nothing was a wise decision or not. Hindsight is always 20/20. Chapter takeaways. The last transaction price is the least accurate measure of the fair value. Prices are dominated by the minority, and values are governed by the majority. PE and other fundamental ratios are useful indicators, but must be used with caution. Discounted cash flow is the correct method of estimating fair value. However, it is hard to apply because of the amount of time and effort required to evaluate underlying assumptions. The inherent risk must be incorporated in the DCF model, either by reducing expected cash flows by a factor of probability or by adjusting the expected rate of return. Markets are not efficient enough to incorporate actual inherent risk, given information bias, and emotionally challenged participants. Instead, prices are adjusted up to the cumulative perceived risk of all participants.